I suggest we get going. So welcome all of you to this week's seminar hosted by Selective. This is the third one in our Autumn 21 ESG series. In our series, we try to bring insightful speakers to talk and share the insights about one aspect of sustainability. Last time we spoke about sustainable securities lending, a topic that is only now starting to hit the mainstream agenda. Today, we're addressing the topic of natural capital and biodiversity as it pertains to investments. Whilst biodiversity, or more precisely biodiversity loss, is a word we have heard before, we hear it certainly less frequently than its cousin climate change. To give a simple metric, I was Googling before this webinar, entering biodiversity loss in my Google window. It yielded 74 million returns, high number. Climate change yielded 10 billion returns. So this is to talk about the difference in maybe the understanding and the awareness that we have of the importance of biodiversity loss. To speak about this topic today, we have the honor of welcoming two distinguished guests, Mathieu Morin, CEO of Iceberg Data Labs, and James Lockett-Smith, Vice President at Verisk Maplecroft. Let me welcome our speakers and get straight into it. First question, setting the scene. James, Mathieu, in order, could you give us the big picture? What is biodiversity? What is the problem? Why should we care as citizens and as members of the finance industry? James.
Okay, so taking those questions in order, and thank you very much for the invitation. Biodiversity can be looked at three levels. You have the macro level, which is diversity between different ecosystems. At a median level, within an ecosystem, a diversity of species. And then within one species, also genetic diversity inside that species. That becomes very relevant when you're thinking about endangered species. There are probably a couple of other relevant terms to bear in mind. One is natural capital, closely related term. This really means the total stock of natural goods that are available. And we call it capital because of the idea that you should be able to value nature properly in order to protect it. Because what can be exploited at no cost will be exploited. Also ecosystem resources, so the flows from that stock of nature that are used by humans, so for example, commodities or water and so forth. Why is biodiversity important within that system? Well, it's a clear proxy and measure of the health and stability of an ecosystem. So well-established ecosystems are typically highly biodiverse. Diversity isn't just a measure of natural richness, but it's also key in regulating and stabilizing natural systems. So typical example would be the kind of predator-prey equations that you learn about at school where, you know, the wolves regulate the deer and vice versa. That stabilizes ecosystems. The problem is that humans are unsustainably exploiting the planet. The concept of planetary boundaries could be helpful here. We know that the Earth is a complex system, and therefore the changes can be abrupt, non-linear, irreversible. And human civilization has emerged in the last 10,000 years or so during a period of relatively unusual stability in Earth systems. So it's fair to ask, where are the limits or the boundaries on the burden of human activities that the planet can sustain before we see those irreversible changes? And in general, scientists have seen the greatest threat in two areas here. One is climate change, and of course the other is biodiversity as measured in terms of extinction rate. Why should we care as citizens? Well, I think we would argue that biodiversity and the richness of the natural world has value in its own right, in absolute terms. And we could argue about that on another occasion, but I think probably most of our listeners would agree. As members of the finance industry, I guess there are a few considerations. So firstly, at the most superficial level, because stewards of capital need to reflect the values of those they're operating on behalf of. So, you know, sovereign wealth funds vis-a-vis governments, asset managers vis-a-vis asset owners, and so on. We're seeing a major shift in those stakeholders in favor of protection of biodiversity, and regulators are stepping in as well. So on that level, finance should care because it has to. Next down will be all the sort of near-term risks that companies are exposed to when they harm nature or biodiversity in some way. So it could be reputational risks, brand damage, fines, litigation, and so on. So if you're invested in equities or corporate debt or real assets, you're going to be increasingly aware of those risks. But there's something more fundamental than all of those, and that is that natural capital as a stock has the ability to continue producing goods sustainably, effectively forever if it's properly regulated. And economies effectively depend on that. The idea that at the beginning of the value chain, there are key commodities and other services being produced without which you don't get society, you don't get any other areas of the economy. And traditional economics sort of grew up with a magical thinking that you didn't really have to worry about those too much. You didn't have to value them. They just appeared and you could take them for granted. But as I said, biodiversity and natural capital are being drawn on unsustainably. And so that, for investors, that has the potential to translate into abrupt and in some cases total loss of value, increase in risk for securities that you might be invested in or entities that you might lend to. Starting at the sovereign level with a country, it could enjoy economic benefits for a period while cutting down its rainforest. Suddenly degradation crosses a tipping point, it experiences a collapse in its commodity production and so on and so forth. Further down the chain to companies and other types of assets. So biodiversity loss presents an existential threat as well for economies and also for markets. And there's a lot of gloom here, but it's not all gloom. There would also be some financing and investment opportunities along the way, I think, as policymakers in particular seek to incentivize biodiversity protection and recovery. And plus, you just see a lot of demand in the market for investment solutions which help to tackle the problem.
Wonderful, James. Thank you for that. Very, very similar logic of your story to that we see in the climate change domain. Mathieu, what would be your additional perspective on some of these aspects?
First of all, thank you for the invitation. Nice to have the opportunity to speak to you today. There are two domains which are under the scope of CDP and COPs: climate, Convention of Parties, and biodiversity. Two domains because they raise in the long term, they jeopardize the planet, the humankind as a whole, and its ability to live and to survive on that planet. And those two topics are serious enough to be under the focus of Convention of Parties, which means that going forward, the regulatory pressure will only come increasing. We have already known that in the climate, and it will unfortunately continue to increase because the situation continues to deteriorate. And we know, we see in the utility sector, in the electricity sector, for instance, the consequence. And if you take a photography today, 10 years ago, about the landscape of electrical utilities in Europe, you can see the dramatic change in business model, creditworthiness, and so on of players which used to be major players due to that regulatory drive, among others. And you will see exactly the same thing for biodiversity on different focus, like change of land use, how your business is contributing to using a lot of land or not, deforestation and not. So different drivers, but under a common concern, which is that globally, we have to make sure that we get things under control and be back under what James mentioned, which are the planet boundaries. Having in mind that for biodiversity, the situation is actually more deteriorated than for climate. We were already beyond the possibility to get back to the situation that we had 50 years ago, where according to WWF, we have lost 70% of vertebrate species. And if you took another snapshot, if you look at birds, oceanic birds living around the coast and in the ocean, nearly 50% of those birds, if you take them, have plastic in their bodies, in their stomachs, and so on, which give you a flavor of the extent of the problem, which contribute to that biodiversity deterioration. So regulatory pressures because we have to deal with it. And if we don't deal with it, that kind of problem will have consequence anyway on our life, on the business model, on corporates, and so on and so on. So, like for climate, it's not a nice to have, it's a systemic risk that you have to factor in your risk management policy, in your investment policy. Otherwise, you will face the consequence of coming regulatory pressures anyway. And to get back to the famous speech of Mark Carney on about climate, we can see exactly the same kind of three different risks. Transition risk. Does your business model contribute to come back to the example of plastic ending in the ocean, reduce the use and the quantity of plastic or not? Or contrarily, do you contribute to recycle it? In which case, as James mentioned, you have a value creation driver, actually. Condition risk. Adaptation risk. Adaptation risk is what I mentioned. You will have regulatory pressure and you will face pressure to reduce the use of change of land use, and we have seen in my country, for instance, in the last 2 years, some very important project to develop new malls, gigantic mall onto agricultural area, frozen after years of development due to controversies and due to regulatory pressure on the need to say, okay, we have to conserve Earth now and not to continue artificializing it. And third, last but not least, the liability risk, because indeed, once the ecosystem services have been lost, meaning the fact that the nature contribute to clean water, clean the air, contribute to pollination, to agricultural yield, and so on, you have to replace them. It has a cost, and someone will have to pay for that kind of extra costs.
Very interesting, Mathieu. And you talk about regulatory pressures and the regulatory agenda. As a student of economics, I know that markets don't revert to the status quo ex ante by their own. And anytime you talk about externalities, you need to have some mechanism that correct for that. It'd be interesting to hear from James. In an interconnected planet, I imagine there's a very strong cross, almost worldwide or cross-governmental or United Nations or otherwise levels of boundaries that are trying to be set. So maybe you can set the scene for us at the macro level in this regulatory environment. What is pushing and binding the behavior of actors in the system?
Sure. Well, I think starting with the international system, the Aichi biodiversity targets with the date of 2020 have been the main sort of framework until recently under the Convention on Biological Diversity. And what's happening now is that there is work going on a new global framework to effectively update that. So COP15 is kind of spread over 2 dates, so concluding in sort of Q2 next year. And the idea is that at those final sessions then the new framework will be adopted. In terms of what's in the kind of current draft, it's good in that it talks about the need to arrest biodiversity loss in fairly stark terms. There are some goals there, and I'm sure this will get adapted and changed in the months ahead, but you can still get a good idea of which direction it's going in. So talking about an increase of 15% in the net area, connectivity and integrity of natural ecosystems. Also about sort of valuing nature's contributions to people. So that going back to what I was saying earlier on about ecosystem resources and natural capital, and then adequate funding. Now, of course, this will really, how relevant this is will really depend on sort of implementation at the national level. But that's, very much the direction of travel in terms of the UN. What's appealing about it from my perspective is that it looks at biodiversity harms as a social and economic problem as much as an environmental regulatory one. And they talk about a whole of government and whole of society approach, and they're also trying to align with the SDGs, which of course themselves already encode some considerations on biodiversity. But I do worry that the time horizon for sort of fulfilling the vision, which they paint of sort of living in harmony with nature, is 2050, even if certain milestones are to be measured by 2030, because 2050 is a very long time away. And we don't, well, it will come very soon, but in terms of biodiversity loss, we don't necessarily have 30 years to wait and see. The other key initiative, perhaps at the sort of intergovernmental level, or should I say actually the regional bloc level, is the European Green Deal. So a set of measures coming out of Brussels, and this is mostly focused on climate change, perhaps unsurprisingly, and on controlling greenhouse gas emissions. But there are a number of policy areas there relating to biodiversity. So earlier this year, they published a biodiversity strategy for 2030 and an action plan, and there are some key concrete areas for action there. So expanding marine and terrestrial protected areas in Europe. So the Natura 2000 protected areas network. So 30% of land, 30% of sea under protection, with 10% strictly protected. And then also restoring and managing degraded ecosystems. And as part of this, we expect, the introduction of sort of legally binding nature restoration targets. And then more funding and an adjustment to kind of the governance framework, and a couple of other aspects there as well around food sustainability and reducing pollution, which are also relevant. And in terms of finance, no discussion of Brussels would be complete without mentioning Sustainable Finance Disclosure Regulation, or SFDR, that all our listeners will be acutely aware of. Among the so-called principal adverse impact indicators there for corporates are biodiversity measures, and we think that will actually be really important in changing behavior, and that's obviously something that Mathieu and others in the industry are responding to. Coming at it from the fixed income side, I do think it was a bit of a missed opportunity on the sovereign side, because there were just two adverse impact indicators mentioned, one on emissions and the other on human rights, and neither was to do with biodiversity. And there you have a major asset class where the data is kind of readily available, and they sort of passed up the opportunity to kind of elicit action there. We could also talk about the Task Force on Nature-Related Financial Disclosures, which is a sort of voluntary initiative, self-consciously modeled on TCFD, the climate change-related predecessor. The aim there is to have sort of complementarity and exhaustiveness between the TNFD and the TCFD. Now, this is super early stage. The idea is to establish a framework for organizations to manage and disclose nature-related risks. It is voluntary, it is early stage, but as we've seen with TCFD, these initiatives have immense power to subsequently translate into, firstly, significant sort of collective action from all the industry leaders, and secondly, perhaps more importantly, national level mandatory regulations that are explicitly modeled on those frameworks. So, that's a very positive development.
And we've certainly seen that in the UK, with TCFD becoming now I think the first country in Europe mandating the TCFD framework. So hopefully, as pertains to biodiversity, other local or national regulators will follow suit. Yes. Mathieu, if we go from this macro or country level or regulatory level down to the investment community, the asset management community, asset owners, what do you see that is worthwhile noticing? Change of behaviors, attitudes, things that you see from your lens?
Well, first of all, there are several voluntary commitment and pledge which are being made by consortium of investors. James mentioned the TNFD, but there are at the asset manager levels, the Finance for Biodiversity pledge, for instance, launched last year and gathering 26, if I remember correctly, financial institution, which pledged to factor in actually biodiversity in their ESG policy, as to include it into their reporting commitment, to engage with issuers about that, and called ahead of the COP15 to set targets, basically state head of state to set targets, which is what we need now to go beyond the footprinting initiatives which have started, and go towards target setting. Other initiatives exist in the Netherlands around the PBF, which is a partnership between several financial institutions. In France, we have the Business for Biodiversity Club around the CDC Biodiversity, setting up a tool deriving from corporate use to be used for financial institutions, and the consortium for biodiversity footprint around the CBF, so steered by a consortium of asset managers, Mirova, AXA IM, Sycomore, and BNP AM, and now with Marshall Wace and Carnot Blue Capital, an English asset manager and American-based, setting up, extending the corporate biodiversity footprint, our solution basically, to develop new KPIs, footprinting solutions, but also dependency measurement and addressing a rather complex issue, which is a positive impact. What is in biodiversity a positive impact, which is obviously an important question in terms of reporting, in terms of marketing, in terms of target setting, and where all these asset managers are willing to make sure that everyone has its agenda, DNA, and so on, but want to make sure that there is a consensus to say it has to be done, reported that way, and what is not a positive impact. More globally, at the EU level, you have an initiative named Aligned, which around that table, you have all the data provider gathered, all the solution provider, trying to make sure, likewise, that we have different approaches fit for different use case, okay, but that there is a scientific consistency all across the board to say, okay, we agree that in the sectoral merit order, the main pressure, the major impact, what is and what is not a positive impact, and so on. We speak with a common language, and that we are aligned with science. And the good news is that we started that work together, and there is already a consensus on what is the merit order in terms of sectors and what the main pressure are, which means that things are mature enough already to start reporting about it, which is a good thing, and which will feed, I think, pledges and announcement made ahead or just after COP 15 by a major financial institution. To begin with, we will start to report on that.
Right. And beyond reporting, which one could say is very important because it provides disclosure as to what the status of a certain parameter is. Do you see, Mathieu, actions? In other words, actions at the level of the portfolio, actions at the level of the engagement, actions at the level of voting, actions at a level beyond that really could be seen to have a genuine impact on reducing the loss of biodiversity?
So actions around reporting, yes, definitely. The report made a couple of years ago by ASN Bank, and last year the first report made by CNP Assurance, or SCORE in France, using our data set, which is the beginning of a journey, because when you have started, implemented that kind of process into your day-to-day management or into your ESG or ESR policy, you start, to monitor from one year to another the evolution and to start identifying the hotspot. Engagement, yes. We have a client, and for instance, I may mention that we provided biodiversity footprint data to AXI, so an association of institutional association in Australia, so with a strong focus on raw material and energy, mining, and so on, willing to use that kind of data set to start to engage with the company and initiate a virtuous circle whereby you say, okay, here is what the most up-to-date model are telling me about the source of pressure on biodiversity. And the issuer will say, but we do also this and that to mitigate, and you should also factor that. And it will contribute to increase and improve the disclosure from corporates, which in return will improve the model. So that's where we are regarding voting policy. We are not there yet, to the best of my knowledge, but for sure we will see. Like we have seen in climate, and the momentum is quite strong at the moment, as you know, and that similar integration of biodiversity into executive compensation, for instance. I think that will be the first step. Probably we will have to wait that the reporting is more mature before saying that.
Brilliant. Very, I mean, extremely interesting. I'd like to maybe turn to the second part of this webinar, which is more looking at how your companies, Verisk, Maplecroft, and Iceberg Data Labs, are helping practitioners in the investment or finance industry at large to address the challenges of the loss of biodiversity. And so we hear a lot about science-based target. I was joking with a colleague earlier today that never have I heard this word, science-based targets, as much as the last 18 months. It is as if scientists are now the new SARS, which is quite cool. I'd like to maybe turn to you, James. We'll run a presentation here that has a couple of pages around your approach, and then we'll turn to Mathieu to hear from Iceberg Data Labs.
Brilliant. Thank you so much. Well, maybe I'll say a few words about who we are in general, and then switch to kind of what we do on biodiversity in particular. So, Verisk Maplecroft has been in existence for almost 2 decades. For the last several years, really since 2014, we have been part of a large US data analytics firm, Verisk, and we work across financial and corporate verticals to help our customers understand, manage, and ultimately mitigate risk. I should mention that we work across a very broad range of ESG, political, climate change, natural hazard, and economic risks. Pretty much everything that used to be called non-financial, that you wouldn't find on a company balance sheet. And our origins were in actually helping companies to understand their supply chain and operational exposure in terms of ESG and political risk in some of the most far-flung places in the world. And then, in the previous decade, we moved into working with investors. So if we could move on to the next slide, please. I can just talk a little bit about the work we do with investors in particular. So we work with asset managers and asset owners across all the different asset classes. I would say that sovereign debt is probably our key stamping ground. You can just see down the left here the various products that we have. The core is the country data, the country risk data. We have about 160 different risk indices covering all countries in the world, and these sit on a foundation of over 1,000 and counting sort of unique indicators, the sources. And the sources come from, it could be structured data, it could be unstructured using artificial intelligence, it could be geospatial data that's particularly important in the environmental domain. It could also be internally scored sort of categorical data on political risk. So we provide the risk data. We provide a lot of qualitative research and analysis. For some of our indices, we look forward into the future using simulation models, and we then break key ESG and disruption risks down to the industry and the commodity level. So, for example, if you were doing a deep dive on ESG risk in Brazil, for example, you might want to understand the the risks associated with, for example, deforestation and soy in particular in that country. And then we do a lot of advisory work as well, really across all asset classes. We help investors with ESG policy development, and then our climate change and environment team works a lot on sort of more custom projects on various aspects of physical and transition climate change risk, and then also a natural capital. So, you know, sovereign debt is perhaps the main asset class, but then we also look into the real asset space as well. Again, you know, this is fairly straightforward in terms of geolocating assets. You know where they are at a portfolio and a fund level. It's quite easy to sort of integrate that up and understand exactly what your footprint is. Commodities ESG is so far quite a niche world, but it's an important one for sort of the leaders in the space. And then, of course, we have equities and corporate debt, where you know, investors will take our data on all sorts of different factors, including environmental, and use it to footprint a company. So what is the risk exposure of a company based on its asset locations around the world? So if we move on a little to the next slide, and just talking a little bit about some of the specific indices that we have in relation to biodiversity. I've just got on the left as well a sort of reminder of what we mean when we think about you know, natural capital and sort of ecosystem services. I think, as Mathieu and I were both saying, there's a host of different ways in which this is relevant to human society, and you know, benefits and goods flow from nature to humans, regulating processes, so regulating the stability of the climate, renewing the soil, supplying commodities and other kinds of goods as well, and then obviously cultural benefits as well. In terms of the specific indices on the right, we really try to address the problem as a kind of whole, a very holistic issue across the availability of natural capital in the first place, its degradation, its management, factors which are driving and enabling it, and then also we look at obviously physical climate risk, as well as a slightly, you know, it's kind of a slightly separate category, but in the longer term you can see all kinds of worrying connections between the two. The majority of the environmental indices are scored very locally. So, you know, if we were just sort of answering the question, you know, what is biodiversity, and you know, how can we measure it? Well, we think about it in two ways. We think about it in terms of protected area status, so around the world, in geospatial terms, where exactly is protected and with what protections. And then we also look at proxies of species diversity in those locations. And we, you know, investors will look at those metrics separately when they need to, but both together, you know, we come up with a good subnational proxy for biodiversity risk. An interesting question that always comes up is, you know, is biodiversity in a location a positive attribute or a negative attribute? If you are a company itself using our data, or you are an investor in real assets, or you're an investor in corporates and corporate debts and equities, then extreme proximity to biodiverse areas in a sensitive sector is, you know, quite obviously potentially a risk, and you want to manage that. But at the sovereign level, obviously having stocks of natural capital is itself a benefit. At the same time, if you were in sovereign debt markets, you need to find a way of incentivizing and scoring countries such that you don't actually, you know, create perverse incentives. You don't want to reward a country in a scoring system just for the fact of having a rainforest which it might be cutting down. So this is part of an ongoing dialogue with our customers, how we do that. And we look at all of the measures of degradation of natural capital. So water pollution, water stress, deforestation, all at a local level, institutional management, so environmental regulatory frameworks, recycling. And then in terms of the institutional drivers of degradation, those are extremely important, as well as the economic ones, and those happen at a national and a subnational level. So just moving on to the next slide, if we could. Thank you. So I just wanted to close with maybe an example of how we bring all of this data together to help our clients sort of understand and manage their risks. I would say that in terms of the way our data is used, it could be anywhere along a continuum from taking data for qualitative decision support, so a human being in front of a screen looking at scoring data and trying to use it to guide their decision making, all the way along to explicit incorporation in models and rules for portfolio construction, right? So the data can be used in many different ways. We tend to operate in terms of normalized scores. That's most common. So you're not seeing the axes on these graphs, but typically it would be between 0 and 10. But also our clients will use the raw values as well, which might, for example, be something like proximity to certain types of biodiversity or biodiverse areas. So the point I really wanted to make here was that just going back to what we were saying about the UN initiative. So biodiversity loss is as much an economic and a social problem as much as an environmental and legal one. And by that, I guess I mean that if it's in the economic interests of communities and societies to destroy nature, and either you don't have laws, or the laws aren't adequately enforced, or the communities around about are in enough economic need, nature is going to be harmed and exploited, full stop. So when we're looking at this problem, we really need to think about the economics and the institutional side, especially corruption, which allows for sort of the laundering of illicitly extracted commodities into the legal value chain. So, the case of gold in Colombia, where only a small proportion of mining activity takes place with full environmental permissions, and quite a bit of ostensibly legal gold exports were actually mined illegally, causing significant environmental harm. And of course, one of the reasons why that is possible is because you can bribe officials to effectively launder what you've produced into the legal value chain. And so what all of that means is that while laws and voluntary and mandatory disclosures by the largest investors and the largest multinationals are extremely positive and necessary, they're very far from being sufficient, because if you don't address what's actually happening on the ground, you're just going to kind of offshore or push the natural capital harms further down supply chains, which are already pretty opaque. In terms of the data on this graph, I mean, we don't need to dwell on it too much, but it's just really an example. But if you think on the x-axis, you have an aggregate of various measures of natural capital degradation. On the y-axis, we have an emblematic measure of one of the human rights risks we cover, which is land, property, and housing rights. So looking at really the forced eviction of communities from land, usually through violence. Then we're looking at how wealthy or poor countries are in terms of the color, and then we're also looking at commodity exports in terms of the bubble sizes. And perhaps no surprise, but it shouldn't be forgotten. Biodiversity loss is inextricably tied up with the social side. In this case, poverty and economic need, along with commodity export demand, are some of the inputs, and violence, expropriation, theft, and exploitation of people are some of the outputs. So if you don't take that into account, you're not actually going to be able to tackle the problem. And this makes it highly challenging. But we will almost always we work with our clients on biodiversity in the context of all these other issues from a sort of broad ESG integration perspective. But they typically try to understand how all of the risks work together to generate a particular outcome. So that's really us. We provide, if I was just to summarize, we're providing a lot of spatial risk data, often at an extremely local level, and we're helping our investment clients to integrate that into their various asset classes in different ways, depending on the asset class.
Jim, that graph I thought was not only a beautiful graph, but also extremely telling. What you just mentioned about effectively in the graph terms, the color and propensity to be more towards the red if you're in the upper right quadrant or the upper side of the quadrant. I'm thinking of the role of companies, and that's going to dovetail very nicely to Iceberg Data Labs here, right? If we think of this graph effectively representing exports and effectively exports somewhere enter into the supply chain of some sort of possibly corporates down to a product for the retail investor. We have the parallel here with the supply chain data, which is still so difficult to get in the climate world, right? What's the CO2 emissions of your suppliers, and how does that effectively affect your total footprint? It'd be interesting to hear from Mathieu, turning to the corporate side, really what you see, how you're helping corporates effectively tackle this challenge, and maybe investors even more so assess the quality of what they have in their portfolios from an impact on biodiversity or biodiversity loss.
Yes, sure. Thank you. Can you hear me? Yes, perfect. Thank you. I will indeed. Iceberg was founded in the first place to address that need and answer that question. If we put ourselves in the shoes of an investor, what is the impact of my portfolio that my portfolio has on biodiversity, which boils down to what is the impact on underlying issuers on biodiversity. And so I will scratch the surface basically in that slideshow to give you a flavor on how we approach that problem in very concrete terms. So next slide, and even yes, perfect. Thank you. So just to remind you who we are a fintech. We are specialized in environmental data solutions, so biodiversity, but also climate, green score, and so on and so on. And one of our value proposal is from one model of what the company are doing, build multiple signals from that model, and we are working for various financial institutions of all kind, I would say, asset owner, asset manager, discretionary management, passive investment, and so on and so on. And we are independent from issuers. We have no advisory businesses with the issuers that we appraise to be free of conflict of interest. So now on next slide, I will spend more time explaining you what were the steps we followed to develop our solution, which is named the Corporate Biodiversity Footprint, which answers to the following question: what is the impact that my portfolio has on biodiversity, expressed along in quantitative terms? We believe that that was the first step, I would say, that it's important to have a quantitative metric, because if you focus only on qualitative approach, looking at their pledges, policies, and so on, you create some bias where you favor the companies that you know the most, or which are nearest you in terms of geographical proximity, for instance, first. And second, you tend to fall into the pitfall that big is beautiful because big is communicating a lot and has a lot of policies. That's where having objective existing metric is useful to correctly measure and model what the company are doing, regardless of what they are telling you what they are doing. The snag is that since you are using a model, which is a proxy of the reality, you should be cautious first, and second, aware and transparent on the limitation of your model, which already exist, which is where following a rigorous method matters a lot. And basically, we did not invented any of the model nor damage functions and so on that we use to translate the pollution, what we name the pressures that the company emits have eventually on biodiversity. All that come from open source and publicly available models, which were developed by the Dutch environmental agency, like the Globio model, which are widely being used by scientists publishing research paper about the impact on biodiversity. Our know-how is to model what the company are doing, and I would say leverage on that all that scientific background to build model which go from what the corporate are doing onto an environmental and here a biodiversity impact. That's where you should be recognized and supported by a scientific advisor, and we have a scientific committee in which we have a representative from WWF, UNEP, and so on, which are not there to endorse the model. It's not their role, but more to advise us and to make sure, to come back to what I said earlier, that the merit order. So when we say that this company in that sector has more impact on biodiversity than another due to its business mix, and that its main source on biodiversity comes from pollution, for instance, that we are aligned with what the scientist is telling us. Be transparent. So we are publishing our methodological guideline, which is not yet on our website, but will be soon, and which can be circulated on demand. And eventually, and that's where, as a data provider, we have a lot of added value, making sure that you may eventually compare companies within sector from different asset classes, aggregate it at portfolio level, including multi-asset portfolio, and making sure that eventually you compare things which are comparable, and you are sure that to identify your key risk. On the following slide, I develop a bit more. So that's the CBF, and basically when we developed and have on the shelf a metric, quantitative metric. And so we use as a metric the square kilometers MSA, which is a surface unit, which is the best proxy that we have on biodiversity to capture the impact on biodiversity. The equivalent to biodiversity of ton of CO2 equivalent is to climate, a database that we enrich, and a portfolio analysis tool. On the next slide, you have an overview of the model. So what we model is from what the company are doing, their flows, so their purchase, their output expressed in physical volume, in physical output. And on these flows, we use what is called pressure factors, which allow us to know from X ton of steel, of yogurt, and so on, what does it mean in terms of land use, release of nitrogen in the atmosphere, release of pollutant ending onto the water, release of GHG emission. It is injected into another model, which eventually converts that, the Globio model, which is an open source model developed by the Dutch Environmental Agency, into MSA. And then we are capable, so mean species abundance, the metric that we use, which can be aggregated and normalized, and allowing us to compare the company when we divided that absolute metric by a financial or a physical ratio, and allowing us to compare companies within a sector or within a universe. We do that on a broad universe and on a bottom-up basis. So it's a very granular approach. We have 1,200 different products which are modeled: agricultural commodities, chemical output, shoes, meat, beef, and so on and so on. And we model that throughout the value chain, because life for climate, scope 3 may be the point in the supply chain or onto the end market where the company has the most impact and therefore risk. I won't spend too much time on the next slide to let time for question. It gives you a flavor of basically the different sources, and we've taken EDF, so Électricité de France, because it is one of the remaining utility in Europe which is vertically integrated. So we approach all as a part of the value chain, generation, transmission, and so on. And it has likewise, it is involved in every generation source: nuclear, gas, wind, hydro, and so on and so on. So it's an interesting proxy of, I would say, the electrical sector as a whole. And you see here the different contribution in terms of pressure, so pollution, and you see that where climate is flat, I would say biodiversity is a building, because we add up to GHG emission, water pollution, land use, air pollution, and so on and so on. So it's multi-layered and more complex, but it's following the same philosophy. And likewise, Scope 3 may be the most material contributor, and all the different production may have a different impact on biodiversity. And we are looking at that granularity in terms of level, which explain you why I mentioned that some of our clients are using that kind of data to engage with their constituent and focusing on the business geography or scope, which are the most material to biodiversity. So it gives you a flavor of what can be done today and at what granularity level we are capable of going. I don't mention it, but the difference between biodiversity and climate is also that for biodiversity, you have to factor in where the pressure are being made. And so there is an asset location and an asset level data component to that approach as well. But well, we may elaborate further on that later. That give you, I would say, a flavor of what is a biodiversity footprint.
Very, very, very interesting. And the edge cases in the climate world that we are quite involved in the selective side are clearly edging onto geographical location of assets, exposure of these assets to climate risk at the corporate level. So we see that dimension as well, but probably the existing of a unifying unit, for instance, carbon emissions is probably an additional degree of challenge that you face on the biodiversity side. Normalizing to one temperature or normalizing to one unit of emissions per value add unit, for instance. Be interesting, Mathieu, to hear. You spoke about use cases on engagement. How do you see the evolution of use cases within your asset owners and asset managers? And then we'll turn to questions that have been raised by the audience.
I see that asset managers are eager to start engaging into a very important sector, which was so far quite out of the scope of engagement for corporates, which is the agri-food sector, which is the most material for biodiversity regarding change of land use and which broach to many issues like food waste, pesticide, deforestation, and so on. So there is a strong focus around that sector at the moment in terms of policy, engagement, thematics, and so on. That's, I would say, my answer.
Mathieu, without one question that comes from the audience, and probably addressed more to you, but we can then turn to James. But and clearly, one challenge that we observe on the indexing side that I observed in the past as an asset manager, you want to have a representation of the world. We are economists. We think of the world in terms of abstraction level in models, but ultimately, what's missing is either the model or the data. And there's this holy grail for the data that can help you, once you've established a model, determine causality, impacts, follow things. The question from the audience here is what is the sort of input data that you have in your models, and particularly the point that you made around the objectivity from company reports, objectivity versus disclosures, what kind of assets level data you use. Can you talk to us a bit about the data challenge of gathering the right stuff for the model?
Yes. Thank you for your question. From time to time, we do bespoke analysis for holdings or private equity investors with, more granular private information. I will focus on the day-to-day business, which is enriching a database, for instance, to develop an index. We use only publicly available data. And here we use environmental data, that's the best, operational data, which is in the majority of the situation. And from that, we model their environmental impact. And when we don't have the operational data, we model the operational data from financial data. Each time we calculate what we call the data quality level indicator, which indicates where the source use and therefore what is uncertainty, the final uncertainty on the result. Which makes sure that eventually, for instance, for a company willing to do engagement, we are comparing things which are comparable. So we can work with what we have, but of course, the uncertainty in the final result will not be the same.
Yeah. And better to use with exact data than imprecise data, but better to use imprecise data than just a gut feel if the model and the logic behind the model and
absolutely
the data modeling side is appropriate.
Exactly.
Although that's even mathematically sometimes debatable. James, are there some things on your side that you'd like to add on the?
Yeah, I mean, I would just applaud the alternative approach that Mathieu is taking. I mean, let's think about what the alternative is. If we think about maybe traditional ESG ratings, if you're looking at a score there which relates to, a company's biodiversity policy, what you're looking at is something which has been coded numerically out of somebody somewhere in a data provider reading probably the CSR report of that company, as well as, doing a scan for any controversies. And, they've taken probably some sort of HQ policy or disclosure information. Again, there could be a heavy dose here of the value of disclosure in itself above and beyond whether the company is actually doing anything well or badly. And then that's been turned into a score. So I think these alternative bottom-up approaches, which don't involve that consumption of top-level corporate, self-reported performance data, should definitely be welcomed. Just from our perspective, the kind of approach we would take, I mean, I already talked a little bit about, the data we're using for biodiversity. We're sort of thinking in geospatial terms. What is the protection status of a location? What is the species biodiversity? And then the key question for us would be, well, what is the footprint of the particular issue or asset on top of that? And then, we or our customers themselves would then be able to sort of generate metrics out of that to be able to understand understand their exposure, and often just use that data in a very heuristic way, perhaps for engagement, for asking the right questions in a way that you couldn't do if you were just relying on the self-reported data.
That's very interesting. I would want to add that even though certainly the CSR reports do not yet have the same risk to directors for improper disclosures than maybe the financial side of the reporting has. Clearly, the direction of travel is clear that increasingly they are bound by the reports they sign off, and certainly the push from investors to get audit and verification of these measures is probably playing in the direction of better and better disclosures. As you mentioned earlier in this seminar with task, the self adhere to task force on biodiversity disclosures, if I recall well the name. We towards the end of our seminar, and I don't see many more questions in my inbox that haven't been addressed in some shape or some form. Just a last question for you before we conclude. And I'm an optimist by nature, so I'd like to ask you both. What do we have to look forward to over the next few years as pertains to biodiversity loss or the reversion of biodiversity? Of what excites you most that we should keep an eye on and rejoice when we see it happening? I had not sent you that question in advance, so there you go.
You first, Mathieu.
I would say in one word, but that's two words actually. Target setting. That's as a next logical step, because it's important to know where you stand, to see what progresses you've made or not. But eventually you have to know if you know how much you have to progress. And so to biodiversity, what the 2-degree alignment is. That's what I am looking forward to. I hope after COP15, probably beyond, but that's definitely an exciting development to come.
For my side, I guess, sort of looking forward to more in sort of the data revolution in terms of visibility through supply chains. I'd like to think that we can get to a world where, you know, supply chain biodiversity footprints are, if not precisely measured, then modeled well enough to be the basis for robust decision making on the one hand. And on the other, I think on the legal and regulatory front, I mean, you referred to risk to directors and auditing. I think, you know, as we move quite quickly towards a world of standardized and mandatory corporate disclosures on ESG, you will get to a place where regulators don't even have to be too precise about what needs to be disclosed. They can just take the approach in the US, which is like, you kind of have to work out where the border lies, and then you're going to be punished if you don't disclose something that was obviously material. And so the regulators and industry will quite quickly work that out. And I think it will be a bit of a shock to begin with, but I think that's the direction we're moving in. And those two things together have the potential to quite significantly change corporate behavior. Now, whether that's enough to actually arrest and reverse biodiversity loss, I don't know. I think there has to be a swathe of other policy actions in the emerging and frontier market world, which may not even be primarily related to the financial sector, but actually to do with, you know, development and regulation of industry.
Great. So some optimism here at the end of this seminar. Great. Listen, James, Mathieu, I would like to, on behalf of Selective and our listeners and viewers, thank you very much for the hour and the time we've put into this. I found this discussion super interesting. I hope our participants did too. We didn't lose many through the course of the hour, so it's usually a good sign. So on this basis, I will thank you again, and then close the proceedings, and looking forward to see both of your organizations and continue to prosper and help investors make better decisions as pertains to biodiversity loss. Thank you
so much.
Thank you.
Thank you very much.